value. I mean, uranium right now as a commodity is at a decade low when it comes to the uranium price, despite the fact that nuclear power growth, demand growth for uranium is at a 25-year high. That dislocation to me just represents a great deep value opportunity. So we're looking to buy royalties on uranium projects, buy uranium projects themselves on U.S. soil, develop and permit them.
And so I really feel comfortable that copper is the best place to be in, and gold, of course, is never going to go away, especially as we have instability in the marketplace. And right now, I'd say globally, there's quite a bit of instability.
And we think there's a large misunderstanding with regard to autocatalysis and the diesel crisis. So the VW diesel crisis in 2015 has played itself out. Diesel sales are falling in Europe, but we think that the amount of diesel cars are likely to be more with higher loadings, and the market isn't giving that any credibility.
Sitting down with Jim Grant. Jim, thanks for joining me today.
You are entirely welcome.
The only thing better than sitting down with Grant is to sit down with Grant himself, with Grant. So I really appreciate you joining me. Wonderful talk just now. And as part of that talk, you invited people to pick up one of these, a preliminary prospectus on U.S. debt.
Yeah, that's a phony document, Albert. I've got to admit that. We have produced, this is a prospectus for the United States Treasury as if the government itself were an SEC filer.
Right.
The government, issues all this debt, but it never discloses, the risk factors. So we thought we would take it upon ourselves to be the conscience of the United States Treasury and produce a prospectus that is satirical in shape and form, but is filled with really interesting facts and just how bad the fiscal situation is.
Okay, so just summarize. What are the most, interesting risks that person?
One risk is that the same government that prints the money also borrows the money. So that would seem to present a clear and present conflict of interest or unity of interest. Another fun fact is that this year, the Treasury will issue, the government will issue, the Fed as a seller of securities and the Treasury as a borrower of money will issue the most government securities as percentage of GDP since the end of World War II. So the supply of government securities in relation to national production is the highest since the mid-1940s, although this country is under arms in some degree, but it's not waging a world war. So this is a very different fiscal picture than one we're ever used to.
So that certainly indicates or suggests that you have a government out of control. But the fact that we're not coming out of a war, that's a good thing.
It's a very good thing.
Had the debt as if we had waged a war without the destruction.
That's not a good thing.
So what do you see going forward then? Let's look at QT, the tightening. How far are they going to get on this before they have to give up on it?
Well, there's there's a school of thought that holds that already the Fed is having second thoughts about the tempo of its balance sheet shrinkage, and there are all sorts of reasons for the Fed to rethink this. The yield curve is flattening. That is to say, the difference between short and long interest rates is narrowing, which has never been a good sign. It's not always the prelude, not the precursor to recession. It's never a good thing for business activity.
Two speakers have already cited the 210 spread in this conference. I don't recall seeing it at all the prior 2 years. So people are certainly watching that.
Yeah.
Should we be taking a different attitude toward it now? Since one person said, for example, the Federal Reserve controls the short end, and people control, or investors control.
True, correct.
But these investors are central banks, oftentimes, right?
Well, I don't think the central banks.
Japan?
Yeah, I don't think they're dispositive. I think that there's a relatively free market and longer dated issues. So we're talking about why the Fed might be reconsidering the pace of its quantitative tightening, so-called, and the yield curve might be one reason.
Okay.
It could just be that the Fed is taking the measure of the rate of rise in the dollar exchange rate in the world and considering perhaps that I think more than 50% of S&P earnings now is generated from abroad. So a strengthening dollar, paradoxically, is a source of weakness for the American stock market.
How much are they worried about impact on emerging markets, emerging market debts?
Well, the emerging markets would like the Fed to be quite concerned. The Fed has protested that it is America's central bank. Then again, the dollar is the world's currency. And the higher interest rates in America redound to the detriment. Listen to for example, the chief of the Reserve Bank of India is very concerned about the effect of rising American interest rates on India. And Indians don't vote in November. So so they get no seat at the table, but nonetheless.
So they have about the same amount of effect that we do on the Fed's independence.
Just
right?
about, yes. Yeah.
Actually, maybe more because they had the prominent central banker who I forget his name right now. But
I think any central banker gets more attention than the attendees at this fine Sprott conference.
Okay. One question I always wanted to ask you is that your letter is quite humbly, respectfully called Interest Rate Observer. Everyone wants to try to predict interest rates.
Oh, don't they?
Control them.
Don't they? Wouldn't they like to know?
This is a subtle distinction, but it's something that I appreciated very much. Interest Rate Observer.
Well, you know, we were in business for about, I don't know, 6 or 9 months. We started in 1983,
Okay.
in the fall of 83. And around the spring of 84, long treasury yields began to ratchet up, and they were 12, and then 13%, and then almost touched 14%. 14% at a time when the CPI was rising not much more than 4%. So it's about almost 10 percentage points of, if you can imagine, of real yield.
Yeah.
And I thought that was pretty fabulous. So I said, bullish on bonds and interest rates will fall. And so my friend said, I thought this was an observational publication. Yeah, so I said, yes, you're quite right. So
it's important to watch interest rates, though, and I think so. Let's talk about yields. One of the things about the 210 spread narrowing is people are concerned about recession. But the other thing is some people are actually picking up yield finally. Like it actually pays to hold some of the stuff now, and it's not just dry powder for this adjustment that you know is coming next year, but it never comes. There's actual
that kind of adjustment.
Yeah. Which is why a lot of people hold.
Sure, yeah, they want bargain hunters who have everything except bargains.
That's right. That's right. But now there's yield to be had.
Yes.
So where are you finding yield, current yield?
Well, I'm going to tell you where one might find it and where one ought not to look.
Okay.
And to begin with a second, very important. Leveraged loans, so-called, are these senior secured floating rate loans that banks may issue, but nonetheless are tradable in the market as securities. They are called prime loans sometimes, leveraged loans more often, and there are many mutual funds that offer them. And the story is that the correct story is that in the crucible of 2008, they did very well. They're senior, they're floating rate, they're collateralized, they're secured. All right.
These are usually to non-investment grade companies.
Correct. They're called leveraged loans, which seem to be a peculiar term because all loans connote leverage, but these are floating rate loans to leveraged companies, to speculative grade companies.
Yeah.
But they're at the top of the capital structure. All right, so that was then. Fast forward 10 years, we've had a decade worth of very, very low rates and increasingly slack covenant protections, the fine print in the loan documents that protects the lender against a borrower squirming out of its obligations. And there is less protection for the senior lender in the structures that are coming out now. There's less debt beneath them. And the covenants, when they're there, so something like 77% of the new loans are coming in without serious covenant protection. So it's a very different value proposition. So I would caution people against these mutual funds that supposedly offer very secure floating rate yields, and they're trading on the reputation that is no longer relevant. So that's what not to do, in our opinion. A suggestion for constructive action is the Blackstone Mortgage Trust, which is a closed-end fund that makes senior and secured commercial mortgage loans. They get in the top of the capital structure, and they 65% loan to value, and they've had a very good underwriting record. They yield about 7.5%. They lend at like 5 3/4 or something, and they get 7.5% to the investors through the magic of leverage. So this is by no means riskless.
Right, but it's about 3 times levered. Full disclosure, do you own this?
No, I don't. But it's 2.5 times levered.
Okay.
And another source of potential concern is they have begun to reach, like everyone has, they're doing some construction lending, but at a 45% loan to value metric, which I think is reasonable, but still, everyone in the world is reaching. And but for people who need income, and there are people who need income, what do you do with your money? Well, one suggestion is the BXMT, the Blackstone Mortgage Trust.
Full disclosure, we own that. I own that in client portfolios. A very good product, 7-8% yield. What about the other, this is like a mortgage REIT essentially. Are there other ones that you look at?
Yeah, there are. AGNC is one we've looked at, and I think it's okay, but the difficulty with the mortgage REITs is that with the yield curve. It's flattening, and they're going to pay more for their borrowing and earn less on their investments. And the trouble with these mortgages, of course, is that when rates go up, you get to keep them as a lender, and when rates go down, they get called away and make you look for a lower yielding mortgage to replace it. So the mortgage business is like a heads I win, tails you lose thing. Is that
right? I think something like that. The Blackstone product, I think, by dealing strictly in commercial, I think they're maybe less prone to that risk.
Yes, they're less prone to that risk. I think it's a superior product. You earn a little bit less on that. Also, you're paying more than net asset value for like 115% of NAV or something. The mortgage real estate investment trust, you are buying at a discount to net asset value, and you're earning a greater yield, but at the risk of a loss of book value as the yield curve perhaps goes against you.
Okay. The other thing they did, this is a novel idea with the Blackstone product, they matched their funding duration with the why would anyone do that?
And that's another structural risk with the mortgage real estate investment trust.
I want to pivot to gold. We were having a discussion in there. What was it? Should you own 90% or 95% of your net worth in gold? Tongue in cheek. That was. What are your thoughts on the gold market right now? It's kind of flat.
Oh, it's horrible. Yeah. But that is the invitation to get interested, right? I mean, the sentiment is just what you'd want as a contrarian. I think it's as bleak as you could hope for. I can't say that gold is selling below net asset value. I can't say that its price-earnings ratio is commandingly interesting, but it is the legacy form of money. It competes with these currencies, and the credit that the currencies, in which the credit, and the currencies, Albert, in which the credit is denominated, I say are both getting increasingly dodgy as the cycle ages. So gold is orphaned, but it competes with other forms of money, that is to say with the dollar and the euro and the yen.
Right.
And it also competes with the promises to pay money, which is credit. And I think that the credit, whether it's corporate credit or sovereign credit, is increasingly precarious because we've had these 10 years of these tiny little midget interest rates, right? And people have overdone it on borrowing and lending. They have lent not intentionally recklessly, but I think that it will be shown in the aftermath of the next recession that much of the lending now was imprudent. So gold, I think, will be a beneficiary of these unwholesome trends in borrowing and lending. And it will be a beneficiary if, as and when, the central banks reverse course and say, on reflection, we have decided not to proceed with the program of normalizing policy. And that will send a signal to people that they have put a misplaced trust in the judgment and capacity of these well-intended, but after all, very mortal and very fallible beings we call central bankers.
Yeah, I think the slightest flinch on their part will send people crowding back into gold, because they've kind of appeared so confident in the plan up until now.
Well, yes, they lead you to believe that they can they have this fine-tuning mechanism that adjusts this and that way. But in fairness to the central banks, in fairness especially to the Fed, I, for one, was not saying 10 years ago, after 10 years of radical monetary experimentation, we will have achieved unemployment rate closing in on 3% and an inflation rate of less than 3%. That was not my vision of the consequences of it. Now, I think still, I've not changed my mind about the ultimate very adverse consequences of these well-intended acts. But you can see, if you're not inclined to be a student of monetary history, if you have no feeling and appreciation for gold as it has served as money, if that is not your thing, I can see where you'd be mystified by someone saying, you must own gold. Why is that? What does it yield? Actually, it yields more than $8 trillion worth of sovereign debt, but never mind that. Gold yields nothing, it issues no press releases, has no CEO to go on Squawk Box for it. It's a very modest asset is gold. It says nothing about itself. And it is hard to compete in a world of fangs, especially when the macroeconomic picture seems so bright.
Yeah.
But Albert, we know it's not.
You realize that we've been counting on you to do that on Squawk Box as our ambassador.
Right. Well, I'm waiting for the call.
Okay. Before we end off, Jim, you are a writer. You've been writing this. What else have you been writing? Books.
Oh yes. Yeah. That's some people play golf. For aggravation, what I do is, well, I've just finished one, Albert, and it's the biography of Walter Bagehot. Bagehot is the 19th century Englishman who wrote Lombard Street, which is the still hallowed manual for central bankers. Lend in a crisis at a high rate of interest without stint. And he was the most famous editor of The Economist way back when. So, but in writing this book, I spent hours and hours with the institutions and the personalities of the gold standard era. So it was a very educational thing for me. I'm not sorry to lose Mr. Bagehot's company. I came to find him rather overbearing, but I did enjoy my time in his era.
Wonderful. And when is that going to be available?
Next year.
All right. Next year. Well, we look forward to that. Look forward to the continued interest rate observer. One reason to observe rather than to predict interest rates is saying you don't look stupid, but apparently it also keeps you looking young. So observe, don't predict. Thank you very much. I appreciate it. All right, we're wrapped. Yeah. Thank you so much.
I'm really good at this. So this portfolio management thing is just sideline.
It's an excuse. It's an excuse to do this.